President Donald Trump is right. The dollar is way too strong and it's killing exports. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today we're going to be talking about the U.S. dollar and when it's too strong or too weak, what its impacts are on the U.S. economy, on U.S. manufacturing, on exports. President Donald Trump had a very strong statement yesterday. He said, quote, "As I predicted, Jay Powell and the Federal Reserve have allowed the dollar to get so strong, especially relative to all other currencies, that our manufacturers are being negatively affected. Fed rate too high. They are their own worst enemies. They don't have a clue. Pathetic." Here, President Trump is responding to the latest Institute for Supply Management manufacturing index reading. It came in at 47.8. Any reading below 50 indicates a contraction being currently underway with manufacturing. So it's not a good reading. And Trump is saying that the dollar is way too strong, and he says relative to all other currencies. So we're going to take a look at this. The president is not wrong. I think he has a very strong case to make on this question. When you look at the U.S. dollar relative to a broad basket of currencies, and this includes, let's see here, Euro area, Canada, Japan, Mexico, China, United Kingdom, Taiwan, Korea, Singapore, Hong Kong, Malaysia, Brazil, Switzerland, Thailand, Philippines, Australia, Indonesia, Israel, Saudi Arabia, Russia, Sweden, Argentina, Venezuela, Chile, and Colombia. That's a really broad basket of currencies, like it says, trade-weighted index of the U.S. dollar, broad on goods. And when you compare that to just the major currencies, the so-called major currencies dollars index, all that includes is Euro, Canada, Japan, United Kingdom, Switzerland, Australia, and Sweden. These are not all of our major trading partners. Europe certainly, Canada certainly. We get a lot of stuff from Japan and the UK, etc. But that doesn't include China. It doesn't include Mexico. And so it's going to give you kind of a not a full reading, I think, of how these things play together. So it kind of looks in prior decades. If you look at major currencies, the dollar seems relatively weaker than prior decades. But if you look at all of the currencies, the broad currencies, I think that you can see that the dollar has never been stronger, and that's problematic. We've analyzed this in the past, where we've looked at the impact of the strength of the U.S. dollar on the broad basket of currencies basis. On the exports of goods, balance of payments. The data comes out of the Bureau of Economic Analysis, the U.S. Census, and what it shows is a strong correlation that as the dollar gets stronger, exports are hit very negatively, and when the dollar weakens, exports tend to rise, because when the dollar is strong, exports become more expensive and our imports become cheaper. When the dollar is weak, our exports become cheaper and imports become more expensive. So people are going to vote with their pocketbooks, and when something's cheaper and it's the same thing, they're going to buy it, regardless of what the source is. That's just rational economic behavior. That's why supply and demand works the way that it does. And so we've analyzed these relationships in the past, and so I think the president is right. This is having an impact right now. That's why you're seeing a weak manufacturing number. The dollar's never been stronger in modern history, relative to this wider basket of currencies. So the weak manufacturing reading from ISM is not at all surprising. By the way, this is what economists predict would happen in the literature. We've looked at the Barry Eichengreen and Jeffrey Sachs paper about nations that were coming off of the gold standard in the past. And what you'll see is that as the U.S. was waiting to come off of the gold standard during the Hoover administration, unemployment was going to the moon. The UK had already come off the gold standard in 1931, and the unemployment rate skyrocketed to over 25%. And it wasn't until Hoover was voted out, Roosevelt came in, they ended the ties to the interwar gold standard, that unemployment started easing. And we have the specific numbers there. Unemployment during the Hoover administration reached 11% by the end of 1930. UK comes off of the gold standard, and suddenly unemployment in the United States is up to 19%, then it's up to 25% in 32, and then it peaks in 1933 at 25.4%. And that was right about the time that the U.S. Came off of the gold standard, and a brief return to deflation in 1938. There was a second recession. This was the so-called double dip recession. You had a return to deflation, and then unemployment spiked up again, just underscoring the point that currency is really, really important. You want to have stable currency. You don't want too much inflation. You definitely don't want deflation. Because if you do, the economy is going to contract, unemployment's going to go up, and your country is going to be weaker. So I think what President Trump is saying here, and he's warning, and he's got economic literature and history on his side here. He's not wrong. I think that we ignore currency at our peril, and Trump is right. If the dollar is allowed to remain too strong for too long by the Fed, and ultimately the U.S. Treasury, which is responsible for the dollar, it can absolutely make any economic slowdown worse, much worse. All of which makes the president's commentary on this topic timely and refreshing, both of those. Unlike his predecessors, President Trump is a hands-on president, and I think he's getting good advice about this, and he's fully aware of the devastating impacts that competitive devaluations have had on the U.S. economy and the American people if they are left unchecked. In fact, the U.S. dollar exchange rates to the Chinese yuan, the euro, and the Mexican peso, some of our largest trading partners, by the way, are at or are reaching highs in many years. So if you look at the U.S. dollar to the yuan, in the early 1990s, the Chinese were devaluing their currency. And then in 2000, they were allowed into the World Trade Organization, and then they were able to do a manufacturing miracle. They grew their economy overnight throughout the 2000s. We lost manufacturing market share. China gained manufacturing market share, and all the while, China doesn't use floating exchange rates. They use the fixed exchange rate, leaving it relatively weaker to the dollar. And since President Trump came into office, they have been again devaluing as Trump has ratcheted up the trade pressure on utilizing tariffs right now. They're trying to strike a trade deal. And we'll see how that goes. But right now, China is still up to its old tricks. They're devaluing their currency. But even countries that use floating exchange rates, here's the U.S. dollar to the euro, and you can see that since the financial crisis and the sovereign debt crisis in Europe, Europe has been devaluing its currency, and that's been ratcheting up. You had a little bit of a weakening in 2017, and then go from 2018 onward. Europe's been weakening the euro, the European Central Bank there, and that's with floating exchange rates. So floating exchange rates isn't a panacea either, because these central banks can engage in foreign exchange operations and absolutely devalue their currencies. Now, here's the Mexican peso. Since 2011, the Mexicans have been devaluing the peso, and the dollar to the peso is reaching its highs again. And this all has a negative impact on U.S. manufacturing. You can measure it. We've looked at this. When the dollar is too strong, manufacturing is hurt. When the dollar is too weak, manufacturing is going to benefit. I think there's a happy medium there where the economy can grow, and you're going to have positive impacts on employment and everything like that. And so this is what Trump is looking at, and he's not wrong. Throughout the 2000s, comparatively weak currencies overseas led directly to the shift in manufacturing production away from the U.S. as economic growth slowed, not topping 4% since 2000 and not topping 3% since 2005. Now, some might look at those developments and ascribe them to free market movements and say the solution to a non-problem is to do nothing. But this really ignores that with the yuan, again, China does not adhere to floating exchange rates. Instead, it sets a comparatively weak fixed standard to the dollar, and it would also ignore all these countries' central banks that are intervening heavily, again, in the foreign exchange market. Sometimes the biggest traders foreign exchanges are going to be these central banks and their government organs, making their competitive devaluation basically acts of economic warfare, a dagger pointed at the heart of the U.S. economy and American workers. The question is what the Fed and the Treasury in tandem are able and willing to do about it. Probably more on the willing side, because the federal government is not powerless. We've looked at this before. U.S. dollar intervention, Congressional Research Service, just a little bit over a month ago, the options and issues for Congress. Here they're talking about things that the U.S. Treasury, the Federal Reserve can do. What they could do is warehouse foreign exchanges and use the Exchange Stabilization Fund basically to quarantine countries' currencies that are printing too much. They print too much money to devalue their currency. We can sop it up using the Exchange Stabilization Fund. The Federal Reserve can assist with that. They have far more firepower. And so the U.S. Treasury could sop it up and then shift it over to the Federal Reserve. Is the Federal Reserve going to do that? Well, for now, they're not doing that. In late July, CNBC reported that the White House had discussed the issue but ruled it out. That is intervening on the dollar's behalf. Any intervention, for now. U.S. Treasury Secretary Steven Mnuchin told CNBC his preference was for a strong dollar. Larry Kudlow, Trump's top economic advisor, agrees. Quote, a stable dollar is very important. And over the long-term period of time, again, the long term, I do believe in a strong dollar. Let's take a look at that CNBC article. Trump decides against currency intervention for now, after meeting about ways to weaken the dollar. So in late July, the President Trump they had a meeting at the White House to discuss this issue. And Peter Navarro, Trump's top trade advisor, was saying, you got to weaken the dollar a little bit here. Otherwise, we're going to get killed on manufacturing. Turns out Navarro was right. But two senior administration officials who declined to be named said that the primary discussion at the meeting trade principles was on ways to weaken the dollar. Kudlow, Treasury Secretary Mnuchin, Trade Representative Lighthouser, Agriculture Secretary Sonny Perdue, Deputy Chief of Staff Chris Slidell, Trade Advisor Peter Navarro, and Council of Economic Advisors Chief Thomas Phillipson attended the meeting. He says, Trump, there's a problem. What are we going to do about it? Said one of the officials, referencing Trump's long-running frustration with currency strength, which he sees as an impediment to closing trade deficits. He's right. Among the ideas debated, the official said implementing capital controls, an idea viewed as extreme by most participants in the meeting, or having Mnuchin and Kudlow actively jawbone, or that is, talk down the dollar. Navarro had advocated for intervention, but didn't make it through 10% of his presentation, according to a senior administration official. The anti-interventionists in the room were armed to the teeth, this person added. And so they discussed it, but they didn't get very far in the discussion because those who prefer a strong dollar are saying, no way, we're not going to weaken the dollar. They prefer a strong dollar, but it's hurting us. If it gets too strong, dollar is going to hurt exports. And so I think there's, again, a happy medium here. We don't want a dollar to be too weak because then we'll have really bad inflation. But if the dollar is too strong, you can have deflation. And what to what Mnuchin says here about a stable dollar is very important and he believes in a strong dollar. Well, those aren't the same thing. The Fed's dual statutory mandate is to maintain price stability and full employment. So the dollar being too strong can run opposite to both. Just as the dollar being too weak can cause inflation, when it gets too strong, it can have a deflationary impact on prices and even cause a recession. That's not price stability. And clearly, it's currently not helping the U.S. economy to remain competitive in the near term. I mean, just look at this ISM index. It's at 47.8, anything below 50. And this is the weakest reading since 2009 at the heart of the financial crisis. So clearly, the dollar being too strong with the broad basket of currencies, which includes all of our trading partners or many of them, coming from, who ship goods to the United States, this is going to tell you that the dollar's really strong. I'm going to bet against the U.S. economy. I'll bet against commodities. You'll bet against gold. If you think the dollar is going to start weakening, you might say, now's a good time to buy gold. Now's a good time to buy oil. Because there's a relative, if the dollar's strong, commodities are going to be weak. If the dollar's weakening, then commodities will rise. And so there's a similar impact upon exports, and it's hurting U.S. manufacturing right now. So I think that price stability is preferable. I agree with that part. Stable dollar is very important, but over the long term, I think it's really debatable what the impact of the strong dollar has been. So if you look at the trade-weighted basis here, the dollar's been really strong since the mid 90s, really. On a trade-weighted basis, it comes in mostly over 100. And so this is when China is about to enter the WTO. And even though the dollar was weakening during the 2000s, it was still relatively strong compared to prior decades, the early 90s, the 1980s, when the economy was booming. And since and after President Trump got elected in 2017, you saw a slight weakening of the dollar, and the economy kind of sprung to life, and things kind of looked like they were going well. And then it's been strengthening ever since, let's see here, about the beginning of 2018. And you got a good reading on the economy last year at 2.9%. And it was the best growth we've seen since 2005. But the dollar's still really, really strong compared to prior decades. And we've seen how manufacturing was outsourced. This was why President Trump got elected, to address all of the tariff and non-tariff barriers to trade that were hollowing out the American heartland. And making the U.S. less competitive, and making our country weaker. President Trump wants to have a strong country, and sometimes a strong dollar is not going to get you there. And so it's debatable what the relative strength of the dollar since the late 1990s compared to prior decades, even as it was weakening from its unprecedented highs hit in 2002, has been helpful to the U.S. economy, following the dot-com bust, the financial crisis, the Great Recession, and the non-recovery of the Obama years. It's all very questionable. It's a debatable proposition, to say the least, that the strong dollar since the late 90s has actually been helping the economy. I think it's actually been hurting. I think Trump's right here. Now, besides intervening in foreign exchange markets, President Trump and U.S. Trade Representative Lighthizer are doing everything else in their powers, including engaging in urgent talks with our trading partners, and when necessary, deploying other countermeasures, including tariffs, when they refuse to come to the table, our trade partners, and deal fairly. But this has its limits, and the U.S. learned this in the extreme case of the 1930s. We were using tariffs in the 1930s, but they weren't the cause of the rise unemployment. That was the deflation. That was the dollar being too strong. And so they focused on what you can do with tariffs. But in the meantime, the exports were declining, and the value of imports, the prices were falling even faster than the value of domestically produced goods. And so ignoring currency, again, you do that at your own peril. But fortunately, Trump is different. For once, the American people, and I'll leave you with the close here. For once, the American people have a president who is not going to sit by idly while foreign governments engage in economic predation, whether on a trade or competitive currency devaluations. And it's about time. But at some point, it may not be immediately. If the goal is fair and reciprocal trade, the currency issue needs to be addressed. Something's got to give. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.